This video review lesson will focus on exchange rates, which is an important component of international economics. The first step in this video is going to be graphing exchange rates and defining what they are. After that, we're going to look at some of the shifters that causes them to change, some connections to macroeconomics. Then we'll look at how the government manipulates them and why, the connections to balance of payments, which is another component to international economics, and finally, real-world examples. So what exchange rates are is basically the value of a currency relative to another currency. For example, you could measure the Turkish lira against the US dollar, which is a common one that currencies are measured against. Think of it as the price of a currency in relation to another currency. One thing to think about though is that even though money and currency are normally interchangeable words, in economics they mean different things. So here we're going to be referring to it as currency and not money. Money is going to be more domestic monetary policy, but currency is exchange rates, international economics. But think of it pretty much as the price of a currency compared to another currency in terms of another currency. And here's the graph, so you can see that exchange rates are governed by the supply and demand for that currency. So when demand rises, the currency will appreciate, and when demand falls, it will depreciate. When supply for the currency rises, exchange rates will depreciate, and when it falls, exchange rates will appreciate. And depreciation is essentially when exchange rates go up, and depreciation is when they fall. As for the shifters of supply and demand, I think a good way to think about it is in terms of a booth, I guess is the right word, where in order to get money, so those two are traded at the exchange rates which they are in the moment. So which is why for the shifters, sometimes you'll see some of them listed for demand and for supply. You'll see what I mean once I explain it a little more deeply. Some shifters can change both demand and supply. It just depends who's demanding the other currency. Think of it as if one country, let's say the United States, is demanding the currency from Ghana, the demand for the currency in Ghana will go up. They demand more of the Ghanaian dollar. So here you can see that exports are a factor in demand, or a shifter of demand, because when other countries demand more of your exports, there's high demand for your currency. Interest rates are also a shifter for demand because it means that more people demand your currency in order to save in your country. So demand will also rise if interest rates in your country go up. Tourism, if people are coming in your country, they're going to demand your currency in order to go there. So if tourists are coming in, then demand goes up. Speculation also has demand go up. Speculation is essentially other people, foreigners, investing in currency, depending if they think it's going to go up in order to make a return to earn money. So if they think that your currency is going to appreciate, they'll invest in your currency, they'll buy your currency, so the demand for it will rise. Inflation is related to exports, because if inflation in your country is high, your exports are going to be more expensive, so they'll fall, which might lead demand in your currency to fall. FDIs, foreign direct investment, is investment from other country. For example, Volkswagen can open a factory in Rwanda. I think that just happened recently, actually. So if countries are coming in the form of FDI, they'll demand your currency to do so, and demand will go up. Whether people from one country is demanding money from another country in the booth, because they'll be giving up, or giving up is not the right word here. They'll be demanding another money with their money, and therefore leaving their currency in the booth. So the supply for that currency will go up. So if people from a country go abroad, let's say if Americans travel to Italy, the supply of the American dollar, Italy, for example, if American tourists go to Italy, as I was saying, the supply of the US dollar will rise because they're leaving the dollars in the booth. That would cause depreciation. Anytime that people are going to a foreign country and demanding their money, the supply of their currency will fall. So the same goes for FDIs. If American companies go set up go invest in, I'll use Ghana again, then the supply will fall, causing depreciation. And if interest rates abroad are higher, people from this country, let's say the US, are going to go there to save their money. So the supply of the US dollar will fall. So that's how some factors such as interest rates and tourism can be both a shifter of supply and demand, as it just depends if tourists are coming in or going, or if or if currency is being demanded or supplied, depending on which interest rate is higher and where people are taking their currency. And how does this connect to macroeconomics? Well, exchange rates affect net exports. If the exchange rates are up, that means that the currency is relatively more expensive compared to other currencies, therefore making it more expensive for foreigners to buy exports from that country. So if exchange rates rise and a currency depreciate, then the demand for that currency net exports will fall because exports are more expensive. However, net exports is also a shifter for aggregate demand. So if net exports falls, then aggregate demand will also fall, which can lead to consequences such as a fall in price levels, which can be positive since less inflation. However, it also leads to falls in employment or output, which of course, if these are sustained, can lead to a recession. However, this is cyclical because since net exports are falling, and remember that net exports are also a shifter for demand of a currency. So if net exports are down, then the demand for the currency will fall, which will eventually cause the same currency to depreciate, which will make the exports cheaper again, relatively cheaper for other countries to buy, rise again, and the same cycle repeat itself. So demand of a currency, since it affects net exports, it also affects aggregate demand and has macroeconomic impacts. So there are reasons that a higher or lower exchange rate could be negative for the country. For example, we've already mentioned that when exchange rates appreciate, when they go up, net exports fall, meaning exports fall, and since the value of the currency is relatively higher, they can afford to import more, so imports will rise. So a high exchange rate can be bad because if a country imports more, then domestic firms are hurt, since they're no longer buying goods and services from domestic firms, but rather from foreign firms. A higher exchange rate also means that exporting industries are hurt because other countries will not be able to afford their goods and services anymore since the price is relatively higher, and instead they'll look to other countries or domestically for those same goods and services. A low exchange rate, however, could be good because employment in export industries will rise, and same for domestic industries because a country will be able to import less. So an idea, however, to consider is the benefits of a high or low exchange rate depending on whether the country is an importing or an exporting country. For example, China, a high exchange rate would hurt it since it's a country that's heavily reliant on exports. Meanwhile, the United States imports most of its goods. So a high exchange rate is positive. Another factor to consider is that a low exchange rate can cause inflation. This is another connection to macroeconomics because resources, factors of production can be imported. So if the price of these go up, then cost of production will go up, which will cause aggregate supply to rise. So a low exchange rate can be negative if that country imports lots of resources and factors of production. In mind, governments can do two things in order to change these exchange rates and produce the effects that they want. They can devalue their currency or they can value their currency. And devaluation and valuation is to be used only when the government intervenes When free market forces of supply and demand for the currency are at work, you use the terms depreciate and appreciate. However, when the government lowers the value of their exchange rates, it's called devaluation, and valuation if they cause it to go up. And there's two tools that they can do this with. The first is interest rates. Rates is a shifter for both supply and demand, depending on if the money is coming into the country or if the currency is coming into the country or leaving the country. So lower interest rates will devalue the currency because people in the country will go save their money in other countries, causing their supply to go up and depreciation or to occur. The government can also buy foreign currency if it wishes to devalue the currency, because this will also cause supply to go down or to go up, which cause exchange rates to go down. If the government values their currency, they can do the opposite and raise interest rates. This will cause foreigners to come save in their country, therefore causing demand for the currency to rise. Another thing that the country can do is use their foreign reserves of currency to demand their own currency, which will cause demand to go up and the currency to be valued. However, so far we've been discussing this only in terms of a floating exchange rate, which is governed by the free markets. Governments can take control over exchange rates of the currency markets one step further and implement a fixed exchange rate. The same tools are used to control the exchange rates. A fixed exchange rate just means that the government sets essentially a ceiling and a floor, and the value of the currency, the exchange rate of the currency, will stay in between there. And then you've already seen the tools that they use to do that. A managed exchange rate can also do the same, but then the government allows a mix of government intervention and free market forces to control the exchange rate of that currency. One good thing about a fixed exchange rate is that there's going to be less speculation and less changes, so there's going to be less economic uncertainty, which can be positive in an economy. The people know the value that the exchange rate is going to stay around, so there's going to be less fluctuations and the trouble surrounding that. Another thing is that it provides a greater incentive for governments to fight inflation, because since inflation affects the demand for exports and imports, which will therefore affect the exchange rate, that's another incentive that the government has to tackle inflation. However, in order to keep and maintain a fixed exchange rate, the government has to sacrifice macroeconomic goals. Since interest rates are a tool in monetary policy, and also for controlling exchange rates, the government is going to have to choose. Sometimes the country may be facing, for example, inflation, demand-led inflation, which would require contractionary monetary policy to fix. However, if their fixed exchange rate calls for interest rates to be lower, then the government will have to do that in order to maintain the exchange rate where they want it at the cost of fighting inflation. Another thing is that the country has to keep high foreign reserves of currency, because since selling your own currency and demanding another currency, or demanding your own currency with your foreign reserves, are a tool for controlling exchange rates, they need to keep high foreign reserves in order to control their exchange rates. And finally, it's just hard to determine the appropriate rate. It's hard. A lot of economic judgments are hard to make since there's just so many factors that economists and governments must account for that it's hard to find the exact appropriate rate. Because if exchange rates are too high, there can be some negative impacts, and too low, there can be other negative impacts, like we talked about earlier with the export and import industries and potential inflation. The balance of payments exports affect the current account, because if exports are up, there's a current account surplus, and if net exports are down, there's a current account deficit. Since exchange rates affect net exports, they therefore also affect the balance of payments. So that's another thing for countries to keep in mind when they're controlling their interest rates. So a couple of quick real-world examples here. The Chinese government devalued the yuan because China is an exporting country. Therefore, a lower exchange rate will cause their exports to go up, which will preserve their export industries. This is something that exporting countries need to eventually deal with. Because if their exports keep going up, as China did, their currency is going to appreciate, which means they're going to lose. Their exports are going to become more expensive, and therefore will eventually fall, which can have economic impacts. So China's devaluation helped it in that sense. However, there's other aspects to consider. For example, the United States accused China of being a currency manipulator. It accused China of being a currency manipulator since it believes that it's gaining an unfair advantage by not letting free market forces determine the exports and imports of a country. So doing this can lead to some retaliation, some feelings, some loss of goodwill between countries. Egypt offers another good real-world example of depreciation. And a rise in supply of money, a fall in demand for the currency, due to factors such as less foreign direct investments coming in. And this all happens at a bad time because Egypt went from a fixed exchange rate to a floating exchange rate, leaving them especially vulnerable to these fluctuations. Because Egypt does not have sufficient domestic agricultural output to sustain its nation. So it needs to import food, especially grains such as wheat. With their exchange rate falling and the currency depreciating, the foreign wheat is relatively more expensive, which makes it harder for Egypt to import these necessary goods, therefore harming quality of life.